Assalamu alaikum. I am Jawad Ahmad. Today we are present in our next economics class with the third learning objective, which is supply and its determinants. So before we can start our class, kindly subscribe my channel so you can get all my videos on a timely basis. Let's start our class. While studying demand, you have to consider yourself as a consumer and think each and every perspective, keeping in mind that you are a consumer. But when you are studying supply, you have to consider yourself a supplier or a vendor or a shopkeeper or a retailer who just want to maximize his profit. So, what is supply? Supply is the quantity of good which sellers are willing and able to sell at different price levels. So, as we have already studied in demand, demand is the quantity which the consumer is willing and able to purchase. Similarly, supply is the quantity of good which the seller is willing and able to sell at different price levels. The higher the price level, it's more favorable for seller because in this case his profit will be maximized. So supply, in order to make a supply of a good, two things must be satisfied. First is there must be willingness to sell the product and ableness to sell the product. What does this willingness? You are ready to sell the products. Means you have a desire to sell the product against a certain price, while ableness means that there must be some marketplace for sale of goods, and goods should be in such form that they can be sold to the customer. They must be semi-finished or they must be finished goods so that the consumer can readily consume them or they can convert it into final goods. What is the difference between stock and supply? Stock is the quantity of the good that is produced and ready to sell but is not offered to the general public at a specific sale price, and it is kept in the stock or in the warehouse, whereas supply is the quantity of good which is ready to sell and offered to the public for the selling purpose. Now study them from these notes. Stock is the quantity of good available to the firm. Firm may not supply all of its stock to the market, means they have kept some stock or some of the goods into the warehouse for some future purpose. Such goods are called stock, whereas supply is the quantity of goods which firms are willing and able to supply. Supply means sale at the prevailing market prices. Now, let's move to the determinants of supply. Determinants means factors affecting supply of seller. First is price of the product. Price of the product has a direct relationship with the supply. Price and supply have direct relationship. That is, price of the product increases, the supplier will supply more and more quantity of this good. So quantity supplied will also increase because at higher prices the profit margin of seller increases and he offers such more and more quantity of good which can increase its profitability. So when price of the product increases, quantity supplied also increases. Similarly, when price of the product decreases, quantity supplied also decreases. Stative, what is reserve price? Reserve price is a minimum price below which seller is not ready to sell his product. Minimum price below which seller is not ready to sell his products. It indicates the price level below which it is not profitable for the firm to supply to the goods in the market. As their profitability ratio decreases, therefore, less and less quantity will be offered to the market, and such point will reach where the supplier refuse to supply any product in the market if prices goes below the reserve price. Following are the factors which affect the level of reservation price. Cost of production. If the supplier has a high cost of production, due to which he intend to receive high prices of this product, and if the prevailing price in the market is low, then the seller will not be ready to offer his product in the market. Second is disposal income of the buyer. If the income of the buyer decreases, its purchasing power also decreases. So there is less chances that the consumer will purchase the product at at such price that is intended by the seller. Therefore, he will not offer his product to the market. Availability of suitable goods or substitute goods. If there is a high chance that substitute goods are available at much cheaper prices than the main good, then the consumer will move towards such good. It will also affect the reserve price for a product. Nature of objectives of firm or marketing strategy of the firm. It also affect the reserve price. So, what we are discussing, the determinants of supply. First determinant that we have already studied is price of the product. Now move to the second one. Second one is cost of input. Input means a raw material or factors of production, the basic inputs from which final goods are produced. If the cost of input, if the cost of a raw material increases, then the supply will decrease because the profit margin of the seller also decreases, and he want to produce such good whose raw material is available at much cheaper price. If cost of input for production, that is land, labor, capital, and manure, increases, supply of such product will also decreases. So, for example, when oil prices or interest rate increases, supply decreases. It's the second factor. Now move to the third factor, which is availability or quality and mobility of factors of production. If less, if raw material is lessly available in such area, then the supply will also decrease. If quality of the product decreases, its supply will also decrease because the consumer will reject such low quality goods. And if there is less mobility of factor of productions, then supply will also decreases because when raw material is lessly available, the quantity that will be produced is also less, and less quantity will be offered to such market. Availability of factors of production, for example, discovery of natural resources, increased supply. Good quality of factors of production also increase supply. Mobility of factors of production from one sector or from one area to another increase supply if better transportation facilities are available. Now move to the fourth one, that is technology. If higher or sophisticated technology is available, then supply will increase because the time taken or the time required to produce a product will decrease. When time of labor will be saved, then the saved time of the labor will be consumed towards production of more and more units. Therefore, the supply of such product will be increased whose higher or sophisticated technology is already installed. Advancement in technology will increase efficiency, and increase efficiency will increase productivity. So, it will ultimately increase the supply of product. Next is fifth one is indirect taxes and subsidies on product. Indirect taxes, if government increase the amount of tax on the production or on the sale of a product, then supply of such product will decrease. Similarly, subsidies are the reliefs or the tax reliefs given by the government. If government increase subsidies on the production of certain goods in order to promote such goods, then supply of such good will also increase. Indirect taxes on product by government decrease supply. Subsidies on product by government increase the supply because the consumer always focuses on the cost of production. If cost of production is reduced due to these subsidies, then he will produce such more and more quantity of goods for which or on whom subsidy is available by the government. Next, move to the other factor, that is sixth one. It is the price of complement goods in production. If price of main good increases, supply of main good will also increase, and the good which is produced through a single process will also, or supply of the complementary good will also increase because the supply of main good increases. Therefore, the supply of complementary good also increases because both goods have to be consumed together by the consumer. So, a rise in the price of complement goods in production will lead to increase in the supply of the goods under examination. So, next factor is, which is the seventh factor, is the number of sellers in the market. If there is high number of sellers in the market, then the supply will also increase because everyone will be providing production of their own facilities. If number of sellers in the market increases, supply for the product also increases. And the last one is expectation about price in the future. If increase in the price is expected in the future, then the supply of this product will decrease at current time or at the current month, and supply of such product will increase in future because there is a high chance that he will earn more profit in the future and the supply of the product will be decreased in future. Similarly, next concept is expectation about demand in the future. If there is expectation that demand for a good will increase in the future, then current supply will decrease. If increase in demand is expected, supply of the product will decrease at today time. What is the relationship between time and supply? Time is significant consideration in determining the supply. A factor affecting demand and supply cause short-run increase in equilibrium quantity. For example, demand for umbrella in unexpected raining season, then supplier will increase their production using existing resources. However, if increase in permanent, for example, change in climate throughout the year, supplier will increase their capacity by opening new facilities. So, what is short run time period and what is long run? The name already depicts themselves. Short run shows a temporary, temporary or conditions for a shorter period of time, whereas long run shows a plenty of time. In short run, because there is a time constraints or time limitations, seller cannot increase its supply beyond its production. Therefore, in short run, some of the factors of production are constant, means you cannot change some of the factors, while other are variable. Similarly, in long run, as there is no time constraints or limitations, supplier can increase its production as well as supply by expanding its operations or through increasing its production capacity. So, it was our today's class on supply. Hope the concept has been well explained. Let's meet in the next class with a new topic. Thank you for your time.